Let me elaborate on one of the points that Jaime made and that we try to develop in the annual report. And that is, why have interest rates been so low for so long? Should we think of them as equilibrium rates, and if so, in what sense? And more importantly, what might be the consequences if they are not? I would like to make essentially 3 points, 3 takeaways. First, the interest rate that we see are not necessarily equilibrium or natural rates. And by that I mean rates that are consistent with sustainable, and the key word here is indeed sustainable, good economic performance. The second takeaway is that this has consequences for the global economy. And in particular, it raises the possible risk of entrenching financial instability and chronic weakness in the long term. And third, this has also consequences or implications for policy frameworks, because to my mind, it undermines the justification for what might be called the separation principle, whereby monetary policy should deal exclusively with near-term output and inflation, think of it as the business cycle, and macroprudential policy is left to deal on its own with financial instability, and for short or simplicity, think of it as the financial cycle. So the structure of my remarks, I will first of all discuss and spend some time discussing the analytics of interest rates, how they are treated in the prevailing perspective, and by the way, that's the perspective to which also the famous savings glut and secular stagnation hypothesis belong. And then in the complementary perspective that we provide in the annual report. I will then elaborate on the mechanisms through which below equilibrium interest rates can generate costs for the macroeconomy. And here, and going back to what Jaime said earlier, I will highlight the nexus between financial booms, resource misallocations, and productivity. And I will finally turn to the implications of all this, of this analysis, for how to interpret the long-term decline in interest rates, and we have seen, for the risks to the global economy, and for policy frameworks. So my first point, the relationship between market and equilibrium rates. Well, first of all, a few facts. I think we all know that interest rates, short and long, and in both nominal and in inflation-adjusted or real terms, have been exceptionally low for unusually long, and regardless of benchmarks. Now, take policy rates first. In both nominal and real terms, they are now even lower than they were at the peak of the great financial crisis. And in real terms, they have been negative for even longer than they had been during the great inflation of the 1970s. Now, this is shown in graph 1, which basically describes an average of the G3 policy rates deflated by core inflation. And you see that they are now lower than they were at the time of the crisis, which is basically the shaded area. And they have been so for longer than they had been during the 1970s. Now consider next long-term rates. Well, it's well known that they have been declining for quite a long time, in fact, since the mid-80s, and I will come back to that later on. But between December 2014 and end May 2015, on average, no less than around $2 trillion worth of long-term sovereign debt, much of that issued by euro area sovereigns, was trading at negative yields. And at their trough, the French, German, and Swiss sovereign yields were negative out to a respective 5, 9, and 15 years. And this is basically what this graph shows. Now, of course, such negative nominal rates have been simply unprecedented. Now, and all of this has been happening even as global growth has not been far away from historical averages, so that the wedge between growth and interest rates has been unusually high. Now, how should we think of these market rates and their relationship to equilibrium or natural rates? Well, both the prevailing perspective and the one that we propose in the annual report, they agree on how market interest rates are determined. That is, by a combination of central bank and market participants' actions. Central banks set the short-term nominal interest rate, and they influence the long-term nominal interest rate through signals of future policy and, as we know, increasingly through direct purchases of assets. On their part, market participants adjust their portfolios based on their expectations of what central banks will do, based on their views about what the other factors that determine long-term interest rates are, based on their attitudes to risk, and of course based on various balance sheet constraints. Now, given the nominal rates, actual inflation determines ex post real rates and expected inflation ex ante real rates. But how can we tell whether market rates are at their equilibrium level or not from a macroeconomic perspective? And I think that here, and by that, let me stress, I mean sustainable good economic performance. Now, in both perspectives, the answer is very similar. That is, if they stay at the wrong level for long enough, when something bad will happen, and therefore that will lead to some kind of adjustment. But what is that something bad? And it is here that the two perspectives differ somewhat. In the prevailing perspective, it is, at the end of the day, the behavior of inflation that provides the key signal. If there is excess capacity, inflation will fall. If there is overheating, inflation will rise. And this corresponds very much to what is also called the Wicksellian natural rate. That is, that rate that equates supply and demand at full employment. Now, the perspective we offer in the annual report suggests that this may be too narrow a view. Another possible key signal is the buildup of financial imbalances, by which I mean strong increases in credit, in asset prices, particularly property prices, and in risk-taking, as one might see in the compression of risk spreads or unusually low volatility. Now, specifically, if one believes that, first of all, low interest rates can contribute to financial instability by encouraging these booms and busts, as many now do, and if we also believe that financial instability has long-lasting, if not permanent, effects on output and employment, mainly through crisis, and as you know, there is plenty of evidence to that effect, then I think it's pretty hard to regard a given interest rate as an equilibrium or natural rate if it generates financial instability, even if inflation is low and stable. Now, clearly, this is partly an issue of the time frame envisaged for the disequilibrium to cause damage. Now, in the prevailing view, this is relatively short because it focuses on output deviations from potential at business cycle frequencies. In the view that we propose in the annual report, it's clearly longer, as it focuses on potentially the larger fluctuations of output at financial cycle frequencies. So that seen from this angle, the statement that one often hears from proponents, for example, of the savings glut or secular stagnation hypothesis, that is, that equilibrium or natural rate is very low or even negative, and that that rate generates financial instability, sounds somewhat misleading. It does not so much reflect an inherent tension between the equilibrium of natural rate on the one hand and financial stability on the other, but rather it is more a reflection of the incompleteness of the analytical frameworks used to define the very concept of the natural or equilibrium rate. That is, frameworks that, as we know, tend to exclude financial instability and its economic costs. Of course, this is not to deny the huge efforts made post-crisis to incorporate financial instability into macroeconomic models, but simply to note that these efforts so far have not sufficiently permeated the policy discourse. Now, what I have said applies equally to the short-term rate as it does to the long-term rate, because there is no guarantee that the combination of central bank and market participants' actions and decisions will guide long-term rates towards their equilibrium. Just like any other asset price, long-term rates can be misaligned for very long, and we know that asset prices do precisely that in the context of financial instability. Now, is this purely semantics? And I would submit to you that it isn't. Because if it is accepted, then if this view is accepted, the separation principle loses much of its appeal. The reason is that we all agree that the central bank task is precisely that of setting the policy rate equal to the natural or equilibrium rate. Let me now move to my second theme, which is what are the mechanisms through which one gets costs, and particularly the link between financial booms and busts and the economic damage that they cause. Now, a lot of attention has been given to the demand side of the equation, that is to debt overhangs and broken financial systems that basically tend to weaken aggregate demand. But I think that the supply side of the equation is also important, and it's here that the nexus between financial booms, resource misallocations, and productivity becomes particularly relevant. Recent BIS research casts further light on this aspect by looking at 22 advanced economies over the period 1980 to 2010, and it basically reaches 3 findings. The first finding is that financial booms tend to undermine productivity growth as they occur, and this is basically shown in this graph. Now, for a typical credit boom, we're talking about over 1/3 of a percentage point per year, and as a kind of lower bound. The second finding is that a considerable chunk of this effect comes through the shift of factors of production, and in particular labor, which is the one that we can measure most easily, to lower productivity sectors. We're talking here about roughly 3/4 of that. Think of this, for example, as shifting resources into low productivity sectors such as construction, and I should add also the financial sector itself. Now, the rest of the impact, this other component, is common across all sectors, and you can think of this as the general impact of capital accumulation or the impact on total factor productivity. The third and probably even more important finding is that the impact of the resource misallocations that take place during the financial boom becomes much larger if after that boom you have a financial crisis. In the 5 years after the crisis, we're talking about something like 0.7 percentage points per year. So that if you take the 5-year boom, you assume that there is a crisis, and then you look at the 5 years after the crisis, the cumulative impact that we're talking about amounts to something like 6 percentage points. Now, again, we should not take these figures at face value, but the important point is that there are effects and that we should try and examine them more closely. Now, what are the implications of this analysis? Then let me point to 3. The first is that I think it's worth revisiting the notion that money is neutral. Of course, this is a very strongly held notion, but these effects are very long-lasting, if not permanent. The second is that it's worth broadening the mechanisms behind hysteresis, going beyond those that are generated by aggregate demand, but also thinking about the mechanisms that occur through the misallocation of resources. And in this context, of course, the allocation of credit is more important than the aggregate amount. And finally, the role of misallocations highlights the limitations of expansionary monetary policy in tackling busts, because it's not just agents that are overburdened with debt try to hold back, or that the transmission mechanism through the banks is broken. But in addition, easy monetary policy cannot undo the resource misallocations that have occurred during the boom. It cannot, and I presume it should not, bring back to life idle cranes, for instance, when there is an oversupply of buildings. Put differently, not all output gaps are born equal, and therefore are amenable to the same kind of treatment. During financial busts, after the financial system has been stabilized, and this is the crisis management phase, removing the obstacles that hold back growth becomes essential. And here I'm thinking of, for example, facilitating balance sheet repair and implementing structural reforms. Now let me come to my final point, the implications of this analysis for how we interpret the long-term decline in real interest rates, how we think of the risks to the global economy, and here the role of the international monetary and financial system that was mentioned earlier is essential, and the possible implications for policy frameworks. So take the long-term decline of real interest rates first. I think that we all know that long-term and short-term interest rates in real terms have been declining steadily since the mid-1980s roughly, and this is what this graph shows for G7 plus economies. Now, the view that we put forward in the annual report provides a complementary interpretation to the traditional one about why this decline has been taking place. In particular, it's not just an equilibrium phenomenon, but in part, and let me underline in part, a disequilibrium one. because it could reflect, in part, the asymmetric monetary policy response over successive financial and business cycles. What I have in mind here is that monetary policy fails to lean strongly against unsustainable financial booms. Booms and busts cause long-term damage for the reasons that I mentioned earlier. Policy responds very aggressively and in particular persistently to the bust, sowing the seeds of the next problem, so that over time this imparts a downward bias to interest rates and an upward bias to debt levels, as you see here in the form of debt to GDP ratios for the countries covered in this graph, and contributes to a kind of debt trap, which is a concept we introduced in last year's annual report. By that I mean that policy runs out of ammunition over time, and it becomes harder to raise interest rates without causing damage to the economy, owing to the large debt accumulation that takes place in between, and owing also to the distortions that I mentioned earlier that low interest rates create for the real economy. So that over sufficiently long horizons, low interest rates become, to some extent, self-validating. Too low rates in the past are one reason, and of course only one reason, for such low rates today. So in other words, policy rates are not simply passively reflecting some deep exogenous forces such as technology or demographics or whatever. They are also helping to shape the economic environment we take as given, as exogenous today, when tomorrow becomes today. Let me now turn to the possible risks to the global economy. And it's here that the international monetary and financial system is so important. Now, successive crises need not occur in the same country, although very often they have. Low rates in countries that are fighting a financial bust, think of them as being stuck in the mud, may induce problems elsewhere. Policymakers try very hard to get traction, but they are finding it hard to get it through domestic channels, so that the exchange rate, and the exchange rate depreciation in particular, becomes, by default, a key transmission mechanism. This induces unwelcome exchange rate appreciation in other countries that may be stuck in the mud themselves or are at different points in their financial cycle. So that in this context, easing begets easing across the world. And I think this helps to explain why policy rates appear unusually low for the world as a whole, regardless of benchmarks. And here, for example, is the case of Taylor rules and range of possible Taylor rules. And you can see that the interest rates, as captured by the red line, have been persistently below Taylor rules at the level of the world as a whole for quite a long time. And I think it also helps to explain why we have been seeing signs of the buildup of financial imbalances, strong credit growth, strong increases in asset prices, in countries less affected by the crisis to start with. And I'm thinking in particular here of a number of emerging market economies, not least some of the very large ones, but also some advanced economies, and some of which are represented here in this room, mainly, but not only, commodity exporters. Now, if serious financial strains did materialize, then the spillbacks to the rest of the world could spread weakness across the globe. And this is why we have a whole chapter in the annual report that discusses the issues with the international monetary and financial system, and Hyun will explain later on a couple of channels through which this might occur. Let me now come to my final point, which is about policy frameworks. Given this analysis, I think that it would be imprudent to rely exclusively on macroprudential policies to restrain the buildup of financial imbalances. In fact, even where this type of policy has been activated vigorously, it has not prevented the emergence of the usual signs of the buildup of financial imbalances, and I'm thinking in particular of a number of emerging market economies. We should not forget that as a means of reining in financial booms, macroprudential tools tend to operate in similar ways to monetary policy. They restrain credit expansion, they restrain asset price increases, and they restrain risk-taking. So that there is a certain tension in pressing on the accelerator and the brake at the same time, as one would if one was loosening monetary policy and then sought to offset the impact of that loosening on financial instability through macroprudential measures. Thus, in addressing financial imbalances, Macroprudential policy must be part of the answer, but I don't think that it can be the whole answer. And there is a role for monetary policy as well. And again, this reinforces the justification for reconsidering the separation principle that I discussed earlier. Thank you.